index, mid-cap index absolutely flat, but there's some green, 30-40 points, but essentially flat. The small-cap index will come up on your screen as well and gives you a quick sense of how we are starting this morning. 24,750 on the Nifty, 55,900 on the Nifty Bank. So this is a very, very muted Friday morning start, but this is just the start. The heat map gives you a sense of how many are up and down on the Nifty 50 at least, and then we'll take it from there in terms of individual names which are making and moving around. So I think it should be kind of sort of no real, it's more down than up, but in a small way, essentially, right? I mean, Sun is on the other one end of the spectrum, Lever is on the other end, as Mangalam just told us 3 or 4 minutes back. So that's the overall picture. 50 points lower on the Nifty. Surabhi.
I'm only going to look at positive things. It's a Friday, Prashant. Look at Chalet Hotels. Forget the Nifty stocks for a second. Look at Chalet. 18% up. What a star. What a performer. The company's top line and revenue, it's grown by 150% in the last quarter gone by. And we'll get perhaps Mangalam back in to explain more to us. Maybe we should just put Chalet on the radar if we can. We'll get to, look at that. Look at that star stock. So even in a tough environment, companies are managing to sort of get investors' attention. Big one over there. In fact, consumption overall is doing pretty good today. HUL is up, Nestle is up. HUL is up 3%. Nestle is up about 1%. Tata Consumer, Eternal, Asian Paints, Trent, even ITC for that matter. There's a little bit of green in all of these stocks, between 0.25% to about 1%. And of course, Lever is taking the cake with a 3% up move. Consumption is the one area which is definitely showing up green. Reliance is very flat. So let's see, if Reliance starts moving higher next couple of hours, it'll be good for the bulls. But on the downside, Sun Pharma, Dr. Reddy, Cipla, Pharma seems to have an overall overhang. I mean, apart from the earnings, etc. I think this overhang on US tariffs is very clearly showing up. And pharma stocks had a very good last 4-5 weeks. So some of that is coming under pressure, profit-taking. M&M also, profit-taking 1% lower over there. L&T, some of the other big stocks on the way down. Bajaj Finance down about 0.5%. L&T down 0.5%. There's Wipro and Infosys, some of the tech names also on the lower side, but mid-caps are brighter. Mid-cap index showing some green, Nigel.
Well, that's right. Chalet, you mentioned, Chambal Fertilizers, the other one. That's up close to around 6.5%, dancing away, so big up move out there. And HUL, for the last few years, everyone's been saying the stock didn't give any returns. In this month, it's given 10% returns. You had the change at the helm, you had the numbers that came out, and there's optimism that consumption will pick up from here on. Just take a look at that stock, 4.5% higher, and that's the big heavyweight. That's the top gainer on the Nifty this morning. What else is doing well? City Union Bank is up close to 2%, moving on rather large volumes, so keep an eye out on that one. On the flip side, Niva Bopa, we just spoke to the management. That's under some pressure. Welspun Living, that's down close to 1%, falling on large volumes, so just highlighting that. And Sun Pharma, actually, yesterday the stock ended lower with a cut of close to around 2%. And today, in fact, it's down another 3.5%. So in a couple of trading sessions, the stock has lost close to around 5%, and that's a large name that we're talking about. Other big winners in the broader markets, UFO Movies, that's moving higher. In fact, volumes are at around 2.5 lakh just in the first couple of minutes. So big move out there. And Team Lease as well. We'll have the management later on who'll be joining in. One more stock I wanted to highlight is NMDC, and I think we should get the stock up and, we should get some details out. Sources indicate to us here at CNBC-TV18 that they have gone ahead and they have increased prices by around 400 rupees. Keep in mind, we're in the midst of a monsoon and they've gone ahead and increased pricing, which is encouraging because they had cut prices for 2 consecutive months. That's in June as well as at the start of July. And the total quantum they had cut it was 650 to around 740 rupees or thereabouts. So because of the price increase of around 40 rupees, that's why, in fact, we're seeing the stock outperforming other metal stocks. It's up more than 2%. And keep in mind, it's a monsoon quarter, but global factors are supporting. So that's one factor. The second factor is, I just had to check that the OMC auctions, there was a price increase as well. So NMDC used the opportunity and said, let us as well push through a price increase. Explains why that one is up 2%.
Absolutely. And, just take a look at the index again. So it's that 45, 50 odd point cut. So not really running away in either direction. It's a very, very slow Friday morning start that we've got happening right now. By the way, the top, I'm not sure if this top volume-led losers. Reliance Infra is down about 4%. It's coming up with large volumes at this point in time. What else? Sun, of course, we've been highlighting. Sun is down about 4% as well. 3.5, about 4%. There is Star Health, which is coming up with volumes. Aurobindo, actually it's Pharma, right? If you had to pick up one kind of trend, it is Pharma. And maybe the Nifty Pharma index will show you it should be down at least 1%. So what have we heard in terms of 1.5% lower on the Nifty Pharma index? Sun, Aurobindo, Dr. Reddy's, Lupin, all these Cipla, they're all down varying degrees. We heard from Commerce Secretary Lutnick earlier today, essentially saying that President Trump is going to come up with those pharma tariffs in the next few weeks. He's going to finalize and declare them. So that's the overhang here. It's been an overhang for a while. With regards to a country like Switzerland, pharma companies based out of Switzerland, if you look at the Swiss index, pharma companies dominate. He sent letters to 17 companies, but that's different. That's not. But it kind of tells you where this is. Perhaps this is going, asking them to lower drug prices when they supply to social security programs like Medicaid, etc. But that's for innovator companies. Here in India, we are talking about generic companies which sell at a much lower cost into the US market, where President Trump is perhaps looking at some tariffs in the coming days and weeks as well. So
Prashant, just wanted to add to that because I was going through a lot of notes on Sun Pharma. So this is not a company-specific thing. If anything, most notes are very optimistic. Plenty of overweight and buy calls on the stock.
Yeah.
But it's just that the extent of their exposure to the US perhaps makes them one of the most vulnerable stocks, in the Indian pharma space. So that's coming off very sharply. Also, the pharma index has been among the best performers in the last several weeks. So it's just quick profit taking and gearing up for what happens.
The thing is, actually, if you remember the conversation with Lupin, Cipla, I remember they gave us numbers, right? The cost of producing a same drug. Forget drug. I mean, I'm talking about a capsule or whatever, right?
Yeah.
I remember Lupin telling us it's about 8 times in the US as compared to India.
Yeah.
So the real impact may be very, very little, even if there is a 10% tariff which is imposed on goods exported, because
you still have to
difference
import.
is so large.
Yeah.
But it's not a good feeling, right? I mean, it just puts uncertainty in the air in terms of what really can happen. And that's essentially what's playing up as far as the stocks are concerned. We have Sandeep Bhatia now is joining us, Managing Director and Head of Equity India at Macquarie Capital. Sandeep, good to have you with us here. Thanks very much. Let's just start with that pharma question. And then maybe we can pedal back and talk about the bigger 25% plus penalty question as well. But pharma, your sense, Sandeep?
Good morning, everyone. I think pharma raises multiple issues. One is the immediate issue of whether Sun Pharma and some other innovator drug companies will get notices like what the Swiss and the other multinational companies have received from the Trump administration. In the last quarterly conference call, my analyst says that Sun Pharma, which derives around 20% of its revenues from innovative drugs, sold in the US, said that they had not received any such communication. But this is anyway, with the Trump administration, everything is work in progress. Everything can change. Even when things are moving in a certain direction, they can move suddenly in the other direction. So that's where we are. So right now, there's a fear that this most favored nation treatment for Medicaid and other US administered medical programs, the pricing of that should match the pricing which the companies charge in other wealthy developed nations. So clearly, there's potentially a pricing pressure that can emerge for the US supplies. So that's where the worry is from. We need further clarity to make a real judgment on whether this is what it is, or whether even I would say that many things can be mitigated by lobbying, and whether, because this is a very industry-wide issue, as correctly pointed out by you, whether this will be lobbied away.
Sorry, that's an interesting point, because so far we are looking at US generics into the US, but you're saying the thing to look at, the metric to look at is exposure to innovator companies, right?
Yeah, so innovative, as far as India is concerned, right?
Yeah, absolutely. So Sun, you're saying, your analyst is saying, Sun's exposure to innovator companies like Pfizer, Merck, Eli Lilly, etc. is about 20%.
Innovative drugs. So that's what I'm saying.
It's about 20%.
Yeah.
So that is the number we need to pull out, and we'll do that and put that up as well, because that is the new part. These letters to innovator companies to reduce what they charge US consumers, and in turn, if these sort of innovator companies pressure their suppliers, right, like Indian Generic and others around the world as well. Surabhi.
Okay, so Pharma definitely a watch point for sure. Sandeep, hi, good morning.
But remember, everything can be lobbied in this administration.
Yeah, everything can be lobbied.
Lobbying, negotiation, pressure. We've almost run out of adjectives to describe this on a daily basis. But Sandeep, morning, the rest of it also doesn't give a very happy feeling, right? And the market's been reflecting that. That's why the slow grind all through July, because anyway, those global tariff headlines are not very supportive in terms of India sentiment. And then you have our own earnings issue. What is your read-through of Q1? I mean, there's no single sector which can really spark off, anyone's imagination. It's not there in IT. FMCG maybe. I mean, people are now hoping that, look at Lever today, for example, this morning. So tell us if you think FMCG can be that safe haven that the market is desperately looking for.
FMCG can be a safe haven is a strong word. I think we need at least 6 months at the very least. I would think 12 months of strong volume growth, which comes to at least 6 to 7%, at least in the line of GDP growth. We are not there. Hopefully, we can get there by the October-December quarter. So that's where it is. I think the real challenge is at multiple levels. If you look at it, the market has continued to re-rate, and that's been the primary driver of the market strength, which is just the PE multiple expansion. On the other side, I would think that the retail participation is a good thing, but we know for a fact that fundamentally stock prices should track earnings, and we have seen earnings lag. So would I mind if there's a sideways or even a correction of 10%? I would absolutely don't mind that. A correction is actually welcome.
But that's my question. That's precisely the question that I wanted to ask, Sandeep. That as you see it from your vantage point, the next 6 months, are you looking at a time correction, which perhaps is not that bad then, or that price correction, like you said, 10% downside?
I would be in the camp of a time correction, just for this technical reason which I was just elaborating, which is the strong retail flows. A price correction is actually more welcome than a time correction because you get done with the pain very quickly. A time correction can be 6 months or even more than a year, and that's actually more painful for the market. A quick and sharp 10-15% correction is what is better from a market perspective. That depends on whether we see any big incremental bad news. I think the tariff news which came out yesterday is not actually that kind of a trigger for the market to correct 10 to 15%. So we'll wait and see if there are more bad news coming out which can correct the market.
All right. So the low of the year at least will get protected, that 21,700 that we saw earlier.
Sorry, I didn't hear this. Your voice was very, very faint.
The low that we saw, Sandeep, earlier this year was around 21,700. So even though the earnings haven't been very, very great, a lot of...
I'm still not hearing that. Someone else can repeat that question, please, because the other two anchors do better.
Yeah. So Sandeep, Nigel's basically saying that we're just trying to, clutch on to all optimism here. Since you're saying the likelihood of a time correction is more than a price correction, so at least the lows of the year should be protected.
I would think so, but I would actually recommend a price correction. Is the sentiment I'm expressing, that a quick price correction would be more welcome than a
better. Okay.
Yeah, but I take your point. I mean, but we have to see, Sandeep, the flows also, and I track that data on a monthly basis. And thankfully, those SIPs are very steady. But overall flows have halved from 40,000 crores. Now we're tracking, 25, 26,000 crores on a monthly basis. But in this kind of an environment, okay, then in this new normal, which would be the sectors where you would park if anyone has additional money, if anyone's looking at, deploying, where should the money go?
I think I would look for a couple of triggers in the market. I would want to see where we are in terms of the US Fed rate cut cycle. I would definitely think that we would see one rate cut coming through from the US this year, probably around the big shopping period there, which is the October-November Thanksgiving period, pre-Christmas. That actually means that we could also see a rate cut. That's not something which everyone talks about, but I would think the likelihood of another 25 bips rate cut post-Diwali for India is increasing, especially if the US cuts rates. So in that sentiment, I would think autos look interesting. We will definitely see consumption impetus in the October-December period. That's the base case that everyone's working on. But the larger high-value autos could see, therefore, improvement if there's one more rate cut. We have seen a 100 basis point rate cut till now, and we could see another for the year, and we could see another 25 basis point, which would be good for consumption, especially for large ticket items like autos.
All right, Sandeep, I hope I'm audible now.
Yes,
What about the hotel space? The last time around we had a chat that, that's a sector that still looks good. Now, some of those numbers in the first quarter have been a little bit soft, but as we heard Mr. Puneet Chhatwal, he was saying that actually this year is going to shape up extremely well. And there was a lot of confidence in his tone as well. Do you think that's still a sector that you would look to get into?
Yes, I think autos is the quasi-consumption kind of story, FMCG, which we were discussing at the beginning of our conversation, but it's a faster growing and more stable. The last quarter was anyway expectedly weak with all the negative outcomes on air travel, crashes, and so on, and the war. But this festival season, again, high-ticket consumption like autos and travel could definitely see impetus come the fourth quarter, and hotels, therefore, would be a big beneficiary.
Okay. And so hotels and hospitality continues to be a space that Macquarie likes. So remember that. We'll keep that on board. Thanks for joining in, Sandeep. Good conversation. You have a good weekend, and we look forward to connecting again soon. Well, that's a view from Macquarie coming through. Let's just check the market again. There's some more pressure now. 75 points lower. The Nifty is just below the 24,700 mark. So let's see how this progresses early in the morning right now. Let's quickly move on to lots and lots of earnings that have come in post-market hours yesterday. And of course, Thermax is one of the companies on our radar. For the first quarter, the company's revenues actually declined. Not too much of a decline, 2% drop, but it's the first decline in several quarters. However, there's tremendous margin improvement that the company has exhibited. So let's discuss the trends with Ashish Bhandari, Managing Director and CEO at Thermax. Ashish, great to have you back on. And we'll start right there. So the margin improvement is looking very good. You're in double-digit margins. But let's first understand what happened with the top line and where the drag came in. I'm just looking at the split as well in terms of the specific sectors that saw some pressure. Industrial products and chemicals, they were up in the previous quarters, but they're subdued now. So just take us through what's happening with the revenue.
Okay. No major red flags. That's the top line story. We have a decent backlog. We just need to work that backlog through the system. In Q4, we had a reasonably big, more than 3,000 crores of revenue. So we started this particular year with deliveries that we were relatively short of delivering, that we had to deliver in Q1. But we also had several customers because of the early onset of rains, where many of our equipment that goes to project sites and all, where projects were running late. So I would say in our math, about 250 to 300 crores worth of orders that we would have liked to ship in Q1, where we were ready with equipment, customers did not pick up. Don't see anything particularly of concern. Most of that got cleared in the first couple of weeks of Q2. Some amount of delays even in Q2 on project side. I think weather's a big pattern overall right now, but nothing to be concerned of. We are building a decent backlog. I expect a good Q2 and a Q3 on the orders front as well. And as we work that through the system, we will increase the revenues as well.
Can you give us some sense, Ashish, on how the year could be? I mean, would it be fair to expect at least double-digit growth? I'm still talking top line, by the way, because you also have exposure to exports, and there's just too much going on with the export markets. So just give us some more color on the revenue. Will it be double-digit growth, and how will the exports business be?
At least we are planning for good growth on both fronts. Some of the events of the last couple of days notwithstanding. And our revenues will follow from our orders. We need to make sure we continue to grow our orders, but our backlog is close to double digit. We just need the book and bill portion also to grow reasonably well, which is what we plan to be able to deliver double digit growth this year. At least that's what we are planning for. On the exports front, if you take a look, the first 2 years post-COVID were largely driven by India growth. India growth was much faster than our exports. In the last 1 year, international growth has started to go up as well. And as we enter this year, we are starting with our biggest pipeline for export projects. That includes Middle East, includes Africa, includes Southeast Asia. To the US specifically, our exposure is through our chemicals business and portions of our cooling business. Those are the two businesses. And in our chemicals business, about 20% of our top line comes from the US. That business will go through some amount of uncertainty in the short term. We hope that uncertainty is short-lived as well.
Okay, all right. Hi, Ashish. Good morning. Good to see you in. Well, last year you said it was a year of planting seeds, and now it seems that, the street will be hoping that fruit is what you'll be bearing in the next few years or so. That said, one positive in the numbers was gross margins going back to around 50%, and the EBITDA margins back in double digits, 10.5% or thereabouts. Could you tell us any kind of those one-offs, those, those problem pockets that we saw in the previous quarters? Are they all behind us? And will the margin trajectory gradually improve from here on?
I think the second part is right. The margin trajectory will gradually improve. We have a couple of areas where we have bad projects in low profitability projects. FGD, a good example of such projects. And in our view, there is about a 1.2% improvement in margins compared to Q1 of last year. That's driven almost entirely by having fewer things that went bad. Yeah, so last year was a tough one in that sense. This year, we would like to continue to show improved margins. We have got some bad projects to work through still. Most of those should get cleared. Yeah, so this year I expect it to be better than last year, but everything that we have been getting in the last 18 months has been things that we like. So our backlog that is building up is of reasonably profitable projects, nothing that is government, large, high civil and construction related stuff where previously we haven't done that well.
So the exit rate of your margins could be, close to around 50, 100 basis points higher than what you have done, in the past quarter?
Let's see how the year goes, but at least that's the work and that's the effort. Yeah.
Ashish, I just want to clarify in terms of exports. What is your total exposure to the US? As a percentage of total exports, how much is going to the US?
I'll say what the US number is. The US number is about $40 million a year. Yeah, which is very small. It's less than 5% of our total numbers. Chemicals is the big portion. Yes. And the second biggest is chillers that we sell to the US.
Okay, but that's helpful to know that overall it's just 5% of your total revenue, right?
Yes.
Total revenue, less than 5%.
Less than 5%, so it's not much of a, there's no need to...
Not much, but there's a secondary impact. We've got many customers in India, especially customers in textiles, pharma, that were expanding quite a bit. Yeah, and those are, if you think about, those are some of the sectors that are investing quite a bit. And as they go through some amount of uncertainty, I expect there would be some. But for Thermax, the news direct connect is relatively smaller. We just have to wait through the next couple of weeks and see how this plays out.
No, but thanks for that important call out that a second order effect could come in via textiles. What's your exposure? I don't know if you have it by industry, but roughly speaking, your exposure to textile players?
We are all 6 to 7%. Pharma would be similar, 6 to 7%. That kind of outlook. But good, most of that, their work is also domestic. Yeah, it's not all driven by exports. So I would say overall for India, I mean, given we export close to $150 billion to the US, there will be an impact. I do hope saner minds will play out and we will find a resolution that works for everyone.
Ashish, always a pleasure having you on the show. Thanks a lot for joining in. You're sounding optimistic about the coming few quarters. We look forward to having a chat with you and hopefully things improve on the ground because you're a bit of a barometer with regard to whether or not the economy is recovering or not. Thanks a lot for joining in. Let's focus on JSW Energy then. They posted a steady performance in quarter 1, healthy growth in profit. That was aided by scale-up in thermal as well as renewable segment. Mr. Sharad Mahindra, the joint MD and CEO of the company, joins us on the show. Hi, sir. Good morning. Thanks a lot for joining in. Well, congratulations. Pretty steady quarters, what you reported. Can you tell us about the contribution of Mahanadi and how will it scale up from here on?
This Mahanadi, KSK Mahanadi and O2 have played a really important role in our quarter 1 performance, which we feel is one of the highest performances what we have delivered. But at the same time, we have to remember that apart from KSK and O2, there are 2 more factors which have contributed to this performance in terms of generation, in terms of margins, is our wind capacity which got commissioned last year was mostly in the second half of the year, post the peak wind season. So this time that capacity being available in the peak wind season, which normally starts maybe around May and continues up to September and part of October, has also played a significant role in the generation growth, wherein our RE generation has grown by 54%, driven by this organic capacity which we had commissioned last fiscal, and also the O2 acquisition. Apart from that, our Ind Bharat Utkal, JSW Utkal plant of Odisha, wherein our second unit of 350 megawatt got commissioned in March 25, has also contributed significantly in terms of energy generation and the EBITDA in the quarter 1.
All right. Well, sir, how did merchant rates pan out, especially in a soft demand year? How much is open capacity as of now?
Yeah, coming first, starting with the demand, of course, the demand growth we have seen has witnessed a negative 1.5% growth over last year. But last year, we have to remember that there was a very high growth of 11%. So on a high base, there has been a negative growth, on the high base. And also, we have to understand that this time, early onset of monsoons also has resulted. So these 2 factors have driven a negative demand growth, but we feel that this is very temporary. Fundamentals of the country in terms of the demand, in terms of the growth drivers continue to remain strong. In our case, when we started the quarter 1, it was the open capacity was almost close to about 1.3 gigawatt. As we are talking now, the open capacity is only 900 megawatt. And out of which only about 100 megawatt, 10% approximately, less than 100 megawatt is on imported coal based. Our Vijayanagar plant, full capacity of 860 megawatt is now tied up under long-term power purchase agreement and has shown a significant increase in the generation as compared to last year. Out of our balance 800 megawatt of open power, which is based in JSW Utkal plant in Odisha and the KSK Mahanadi plant. We have to recall that both these plants are in the coal belt. The fuel cost is extremely low. This gives us a big advantage because of the low cost of generation to sell in the merchant market. Lastly, what you asked about the tariffs, merchant tariffs during this quarter have averaged in the exchange at 4 rupees 41 paisa. But I'm happy to tell that we have been able to sell our entire untied capacity, which I just mentioned, at an average price of 6 rupees 14 paisa through bilateral and medium-term contracts.
Okay. So, Mr. Mahindra, putting it all together, when you've got 3 new units on stream and that O2 platform, can you give us some sense or a guidance for fixed EBITDA growth for the current year, FY26?
See, in terms of KSK Mahanadi, we have already demonstrated the performance with 857 crores of EBITDA in quarter 1. And we all know that last year, the KSK Mahanadi, the operating EBITDA was about 2,400 crores when we were not there. We only came on 9th or 10th of March last year. So we are absolutely certain that seeing the quarter 1 performance and the efficiency improvements which we had started immediately after the acquisition in the month of March, Some of them have already been implemented, some have been partly implemented, and balance will be implemented during the balance part of the year. We are quite confident that this benchmark EBITDA of last year, operating EBITDA of 2,400 crores, will be definitely significantly higher than that. And that will remain higher on a sustainable basis going forward, or maybe next few years. In terms of the EBITDA, as I said, Q1 performance has already given us an idea. Maybe it can be checked upon. We normally are not in a position to give the numbers for going forward. No one knows. But we are absolutely certain that with the sustainable operations, sustainable EBITDA, entire capacity tied up, barring this 90 megawatt of untied capacity, we are certain that we'll be consistent and will be demonstrating what we have demonstrated in Q1.
Okay, well, Mr. Mahendra, what is the capex required for reaching the 2030 target? If you can wrap it up with this, what are the internal tweaks between earlier and right now? How will you fund this capex program as well?
As we had said earlier, when it was earlier before our announcement of Strategy 3.0, we had said that 20 gigawatt by 2030. Then we realized with the order books, the PPA signed, work under construction, we had revised that to our capacity targets to 30 gigawatt by 2030 and 40 gigawatt hour of energy storage by 2030. And we are absolutely on track. As we have said immediately after the acquisition of O2 Power, with 1.3 gigawatt of operational portfolio which we acquired, and we reached about 12 gigawatt of capacity, that will be adding another 3 to 4 gigawatt in the current fiscal over and above that 12. And going forward, the PPAs which we have to deliver maybe in next 2 to 3 years time, which is total 10 gigawatt, we are certain that we will be achieving. So we are absolutely certain of reaching 30 gigawatt of capacity, operating capacity by 2030 and 40 gigawatt hour of storage. As capex, we have given the guidance for this 30 gigawatt by 2030 and 40 gigawatt hour storage. The total capex we envisage will be almost 130,000 crores during this period up to 2030.
Okay, we'll take a quick commercial break. Thank you very much, Mr. Mahendra, for joining us and running us through all those updates. We come back with Arul Selvan, Managing Director of Cholamandalam Finance, Investment and Finance, to talk about their first quarter numbers. Welcome back. Just a quick look at the market. We're down about 60 points. 24,710 is where we are at right now, about 0.25% lower. Let's just look at the Nifty Pharma index, because that is essentially where the big pressure has been coming from all morning. And we've been trading for about 40-50 minutes or so. DRL, Cipla, some 2% of the Nifty Pharma index. You know, there is an issue with regards to news flow, which is impacting, something new which is impacting at the margin. Let's talk about the first quarter performance from Chola now. And we have the company's president and chief financial officer, Arul Selvan, who is now with us as always. Mr. Selvan, good morning. Great to have you with us here on CNBC-TV18. So two questions, and I think you know what's coming. One is growth seems to have slowed a little bit. Maybe you did point this out, call this out earlier. So on a quarter-on-quarter basis, disbursements are a little lower. So one, if you can guide us towards what kind of growth and disbursement you will see for the year. And second is there is some asset quality deterioration across segments as well, across most segments actually. So I think some guidance on that will also help. Go on, sir.
Sure. First on the growth, so the growth has been impacted on two counts. One on the consumer and small enterprise loans, where we had consciously reduced our exposures to the Fintech partnerships. We have spoken about it. We started reducing it from Q4 and continue to completely exit this in Q1 this year. So that has had an impact on the overall growth, because that by itself was a 40% disbursement drop compared to previous year first quarter, where this was going full steam on all the partnerships we were having at that point in time. The second area is where in SME we have consciously reduced growth in certain parts of the SME segment, which is the supply chain finance and the loan against shares, because these are not adding ROTA to the bottom line of the company. So we have consciously slowed down on these two segments, because this is not turning out to be a better ROTA product. But for this, the LAP has grown. Actually, VF has grown around 7%, which is better than the industry growth by itself. Industry by itself is muted in VF. And this is a general phenomenon that happens in Q1 of any year. And so we are not really unduly perturbed about this particular slowdown. We will see that it will catch up. As you know, we consciously focus on AUM growth, and we still stick to our stance on the AUM growth, that it will be in the range of around 20 to 23% for the full year also, which is what we have already clocked in Q1 now.
Okay, so 20 to 23%.
Sorry, just to follow up. So you're saying growth has come off because of specific issues at Fintech also. So I had two or three questions. One is on the Fintech side. I mean, I think this happened 3 quarters back, right? You're kind of slowed down consciously.
Started slowing down 3 quarters back, progressively exiting one after another of the Fintechs. And in Q4, we exited completely, end of Q4. So in Q1, we had 0 disbursements through the Fintech.
Okay, so it's completely now come to 0 then, right? I mean, and that's essentially...
On the Fintech part, which is 25% of the CSL book, the traditional book continues to grow.
Okay, fair enough. And the other question was asset quality deterioration, sir, across the board. So what's the guidance there?
So in every Q1, you would see the comparative to Q4 asset quality will come off. If you see last year, it was even more pronounced, change over Q4 of the previous year, FY24 versus Q1 of FY25. But this year we actually hinted that while the Q4 benefit was not that much, we also hinted that the movement from Q4 to Q1 would not be that high. Last year it was more than almost like 100 basis points. This year it's around 30 basis points, 50 basis points if you compare Q4 versus Q1, and 30 basis points if you compare Q1 versus Q1. Yes, there is a little bit of a higher stress. This is primarily arising out of 2-3 reasons. The early onset of monsoon had pushed the vehicle finance NCL to be slightly on the higher side because the vehicle operators were not able to operate. The open cast mines are flooded, and that has also resulted in certain segments of the construction equipment borrowers not able to earn, through this particular Q1. As you know, most of our customers are earn and pay type of customers. They are not fleet operators with large pockets. So that is where you will have this sort of immediate reflection of something happening in the economy or something happening in the environment impacting them, but they also quickly bounce back. We expect them to come back with the better.
Mr. Selvan, one of your competitors called out a broad-based issue, a slightly broader issue, and that, of course, I'm sure you've seen it. You're not seeing that, sir? A generalized kind of stress across segments?
No, we are not seeing that. For us, if we see our only expectation is to have a decent monsoon, which gets completed by at least by the early September. Unlike last year where it got extended to November, if that happens, yes, the stress will continue into Q2 and a bit in Q3. But if the monsoon, because it has come in early, and the prediction so far is that we will have a decent monsoon and it should also end in Q2. If this happens, the bounce back in the customers.
Can you give us some numerical range to understand this? Because the rise in credit costs was in the first quarter was more than what the market had in mind, 50 bips. And you've explained why monsoon seems to be one big trigger. Now, where will your credit costs be as things stand? If things normalize, and there's Q3, Q4 as well, no monsoon issues over there. Where will you end the year with respect to your credit costs and also the GNPs? Now, provisions also have gone up in the first quarter. So clearly you see something ahead. So just give us some guidance on, gross NPA levels by the end of the year, credit costs by end of the year, and whether you'll need to take higher provisions in Q2 as well.
All of them are interrelated. So the moment the gross NPAs should be similar to what we are closing this year, closed last year, that is around the 3% number. And we expect the credit cost should be in the range of around 1.5%, 1.4 to 1.5% when we close the full year.
Okay, credit cost of 1.4 to 1.5% full year.
Yes.
Okay, so that your shareholders will be happy to hear, because that means it will come down from where it is at the start of Q1.
Come down. So the seasonal Fintech exit has created a certain amount of larger credit costs on that segment, which will come off by the time we close the year.
Got it.
We'll see that in one more quarter and slowing down in the subsequent quarters. So that would.
Yeah, no, that's great to understand, sir, because from what you're describing, this looks like a seasonal issue and not a wider structural economic issue that will last through the year. Got that point. Just a quick word on margins as well, because in the first quarter, we've seen, I think, about a 20 basis points compression. What do you expect for the rest of the year as the cycle continues and maybe we get another rate cut from the RBI? Margin expectations for full year?
See, as I spoke earlier, the rate cut benefit has not come through in our numbers in Q1. You'll see that rate cut benefit coming through from Q2 onwards, because there is a lag effect of the pass-through happening by the banks as well, even on the ABLF, because that was only the larger cut came in at the fag end of the Q1. So you'll see that benefit coming through. To some extent, on the floating rate book, we may have to pass it off, but on the still, we will benefit on the larger fixed rate book. So we will see that coming through. So overall, around 15 to 20 basis points improvement on cost of funds will be clearly visible when we close this year, and that should flow through to the NIM. OPEX should be held at 3%, and if we cut down the NCL to the 1.5% from where we are today, we expect the PBT ROTA should be in the range of around 3.4 to 3.3%.
Thanks a lot, sir, for joining in. We look forward to having a chat with you. Wishing you a good day ahead and all the best. Hopefully, things look up for you as well as the industry. The next management on our show is Amber. Well, the numbers look quite good, but to detail the past quarter and explain why was it so good, we have Jasbir Singh, the Executive Chairman, CEO and Whole-Time Director at Amber Enterprises that joins in. Hi, Mr. Singh. Good morning. Thanks a lot for joining in. Well, the growth in the RAC business was very, very strong, but in a weak demand environment. So explain it to us. How was this possible? Was it pre-lag manufacturing? If yes, then quarter two in all probability could be a washout. Explain that to us.
Well, the good performance in the quarter one has been a function of a couple of points. First of all is our component business, which has paid dividends, which we have been working on from last four years. Then the commercial air conditioner segment, which we added about 2 years back, that is also gaining traction. And then the mix of the gas charging companies which we were doing gas charging for, that has been converted into full ODM products now. And of course, the non-room AC components which we have added last year. So all these four points are actually adding us to deliver a good result in quarter one. As far as quarter two and quarter three are concerned, normally these are bleak quarters for the AC industry, and I think we will move in tandem with the industry. But we have guided, and I don't mind repeating it again, that we are very confident of outnumbering the industry growth by 10 to 12% by the year end.
Okay, all right. And in terms of volumes, you want to give us a number? RAC volumes, last year, what was it? This year, what will it be?
It's actually very unpredictable because we have comprehensive solutions which we deliver. We deliver components as well as finished goods. We don't control the demand side from the customer, so we give a complete package as in the form which they want. So it's very difficult to predict the volumes.
Okay, all right. Mr. Singh, what looked up as well as the electronics vertical? It looked very, very strong. You're doing ballpark, what, 770 crores in the first quarter itself. And you've given a target of around $1 billion of revenues from electronics in the next 3 years, with margin scaling that 11 to 12.5% range. Could you help us out with, maybe in the next few quarters, you get to around the $500 million target on a run rate basis, on a quarterly basis? Will the exit rate for this year actually be in that vicinity or a little bit more?
So actually, if you see the journey of our electronics sector, we started electronics vertical in 2018 by picking up 70% stake in Ilgen Electronics. It was at that time a 300 crore company with 2.8% EBITDA. After 2-3 years, we started adding different applications in the industrial part on the electronic side. First of all, we added the hearable wearable in 2022. Then we added automobile sector. Then we added some customers in smart meters. Now we've added a small customer in the defense sector. So industrials, defense, aerospace, and the medical was missing. The two acquisitions which we have recently done, Power One as well as Unitronics, has added the industrial vertical. And with all these add-ups, we are confident that achieving $1 billion number by 3 years, next 3 financial years, is very much possible. And that's why we guided the market about this number. And I believe as a India, we are consuming a lot of electronics, and the content of electronics in every sphere has also increased. Just to give an example of air conditioner, earlier we were using about 400 rupees of PCB in an air conditioner. Now it is about 2,500 rupees. So that's where we are confident of delivering that number.
So FY28, Mr. Singh, good morning. FY28 $1 billion, right? From this business.
FY29. Next 3 years after, FY29.
Okay, so starting 27, 27, right. 28, 29. By 29, $1 billion in revenues.
Yeah.
And with regards to electronics, you've entered into, you ran us through all the segments. You are where you need to be, or will you continue to sort of enter newer verticals there as well within electronics?
So within electronics, one thing we did in 2024 was we acquired Ascent Circuits, which is into bare PCB board. Now, bare PCB, why we did it was because we wanted to give a comprehensive solution in terms of the components of PCB applications and the complete electronics as a whole. So that was our first step to backward integrate into component sector. And that is one business in which there is a big TAM. Today, out of $4 billion of PCB getting consumed in the country, only 10% is getting manufactured. So that is the first addition we have done. Second addition we have done is power electronics, which is Power One company. They manufacture battery energy storage systems. They do UPS and they do solar inverters. So that space itself is growing pretty well at a CAGR of about 20%, 25%. And the third one is Unitronics, which is into industry automation, 4.0 products, which is programmable logical controllers and also the human-machine interface and also the drives. So this whole sector, we have added the TAM of almost about all three products, PCB, power electronics, and the HMI PLC. This is a TAM of almost about $12 billion. And I think we will continue to add some more products in the defense and aerospace by organic and inorganic way.
Okay. $12 billion from these three segments in electronics, right?
That's right.
And this is the India TAM.
This is India TAM.
Yeah.
See, India as a whole.
And your focus in all three is India.
Yeah. So India as a whole, 8 years back, India was consuming $32 billion of electronics. In 24, it consumed 115. In 25, it consumed 130. Business as usual, it should touch about 300 billion electronics getting consumed in the country by FY30. So we are taking care, we are building blocks carefully and gradually.
And the margins, Mr. Singh, will that 11.5%, as you continue to backward integrate, and we've heard from some of your other peers we speak to as well, that as you backward integrate, margins get a lift. So so that 11 to 11.5 FY29, you'll exit 29 with $1 billion and 11.5% margins, or it could be higher.
That's right. I mean, as of now, the building blocks which we have done, it looks possible 11.5% with $1 billion by FY29. And if we continue to add some more applications which are at a higher margin range, then of course it can go further up.
Okay.
Okay. All right. We'll leave it on that note, sir. Thank you very much for joining in. Good to get perspective on the business, and we wish you good luck for the rest of the year. That's Amber. Stocks showing up in green. They've had a good quarter gone by. By the way, check the market out and check Mahindra & Mahindra. Again, solid numbers coming through, 20% rise in their PV sales. And the stock is recovering from the lows, from the lowest point, though it's still, of course, slightly down. Another stock that's down and down quite a bit is PNB Housing. Let's bring Sudarshan back in. It's this sudden resignation of Mr. Kausgi that has taken the market by surprise. Sudarshan, tell us more.
So after today's fall of around 15%, stock is now down more than 30% in last 2 weeks. And today's fall is mainly on the back of sudden resignation of MD and CEO, that is Girish Kousgi. Remember, in 2022, when he was appointed MD and CEO, his term was for 4 years. But now, after 3 years, so basically his resignation effective date would be October 28, 2025. So basically, he'll be resigning after completing 3 years. Now, if you take a look at the stock move out, once he had joined or once he was appointed MD and CEO, that time stock price used to be around 370 rupees, and from that level it had moved as high as 1200, so it's up almost 320% from that level. So it shows you, and he had some aggressive growth target going forward also for FY26, but now his sudden resignation has come as a shock for the market. And after that, MS has come out with a note. It has maintained overweight call, but has cut target price to 1100 from 1300 per share. It says MD resignation casts uncertainty on growth plans, and also investors may be concerned on way forward, basically in terms of execution. And MS expects that it may have a negative reaction on the stock that already you are seeing on the screen, down almost 15%. But it has maintained overweight call mainly because of the reasonable valuation. But overall, it's negative for the stock.
No, absolutely. So thanks very much for that. Very useful. We'll take a quick break. Mitesh on the other side with some trades. Stay tuned. Welcome back. As promised, Mitesh is with us with what he'd want you to do in terms of specific trades. Markets bounced, by the way, off the lows. Mitesh, take it away.
So, the market still is showing signs of mostly, contracting kind of an activity. The buying which happened, yesterday didn't see follow through. The selling today morning didn't see follow through. So it's a market which is not giving you directional bias. So trade with stock specific biases. I have a sell on Tata Power. If it breaks today's low, so 391 is the low. I think if it starts trading below that, there's a pivot around the 391, 392 zone. If it starts breaking below that, sell with a stop at 397. Look for a target of 380 to begin with, maybe even lower. And Power Grid is another one on the sell side trade. Keep a stop just above levels of 292.5. Look for targets of 275.
Okay, all right, got it. Mitesh, thank you very much for that. Well, with that, let's quickly shift focus to commodities as well and see what's happening over there. Manisha, tell us what's on your radar.
Well, I'm looking at copper. While almost all commodities or major commodities have seen a decline, but copper clearly continues to get pounded on the lower side. We've seen 6% of a decline in the overnight markets, and this is after 18% of a crash that we saw on 30th of July, the biggest intraday decline that we've seen since 1988. That is exactly when the market started to keep sense or record of prices. So this is the biggest intraday decline that we've seen come in for copper on 30th of July. So with this, when you look at the overall prices, on the week, we are down by 24% for copper. In last 1 month, it's turned into negative by 15%. For the year until now, we still are into the positive of around 10 to 11% there. But this is all happening after US has excluded refined copper imports from that 50% tariff that gets implemented from today onwards. Well, copper did hit record highs of 5.9. This was until the market did not know what the clarity was and what kind of copper imports would be allowed or excluded. So the markets continued to buy into the US, and we saw all-time highs at 5.9. Currently, with all that profit taking and the premiums absolutely vanishing, we are down to 4.3. Also weighing onto the markets is the China factory activity that shrunk to 49.5. Expectation was 50.2. Last month was 50.4. So in all senses, we saw a weaker number coming in there, also weighing on many of those industrial metal prices there. Interestingly, when you look at the stockpiles in the international markets as well, that is clearly messed up, as you would say. When you look at the COMEX markets, ahead of this 1st August implementation of 50% tariff, you saw a lot of excess inventory coming into the US markets there. So when you look at the overall inventories in US right now, they are at a 21-year highs. Take a look at the overall supplies as well. In COMEX, we've seen supplies go up by 170% to the tune of 253,000 tons there. In the LME, in the meanwhile, you've seen supplies get declined by 50% in the year till time. And markets do believe that with the kind of excess that US has right now, you will see that supplies going or flowing back into the London markets. So the next couple of months perhaps is exactly what we will be looking at, that balance being recreated when it comes to copper availability across the world. Interestingly, what the White House continues to tell us is that, and this is as per the paper released, that they have not ruled out future tariffs, especially when it comes to refined copper. So that tells you or doesn't tell you much there. But the Commerce Department has recommended a phased universal duty on refined copper. This could come into the tune of around 15% in 2027 and nearly 30% in 2028. But whether or not this is going to happen or not will be only known by the month of June or July in 2026. That is when the next review for copper imports is going to be happening. So clearly, it's not over yet. We have tariffs in place today, but this could change anytime.
Okay, all right, Manisha, thank you very much. Very helpful primer as far as where tariffs on copper really stand at this point. Time for a break. We're back. It's our segment, The Economy, Lata in Conversation on the state of the global and Indian economy post-tariffs with Chetan Iyer of Morgan Stanley. Coming up.
Welcome back. Asian markets are somewhat sulking after the announcement of the final tariffs for most nations. India, which has suffered a worse shock of 25% after hopes of around 15% tariff, is actually holding up in terms of at least stock market performance, especially in the last half hour. There are still many moving pieces. The rate on China is still under negotiation. India faces a threat of possible additional penalties sometime soon. But some of the dust has settled. So how are the current rates likely to impact global growth, Asian growth, and hence India's growth? I have with me Chetan Ahya, the Chief Asia Economist at Morgan Stanley. Good morning, Chetan. Thank you very much for joining me on what must be a busy morning for you. What are you all marking down, either global growth or Asian growth, after we now know the final tariff numbers?
Well, not really, Lata. I think we were all expecting that tariff numbers will be high. The last round that we had seen was a minimum of 15% for most of the large Asian economies, and then some of them had 19 and 20. So in that context, the development overnight is not really a big news that we need to change our numbers. Remember that in India's context, we have always mentioned that the framework to look at would be to see who is more exposed to global trade, i.e. goods trade. And we therefore had India getting impacted the least across the region. And that framework still is intact pretty much, Lata. So it's not the direct effect of tariff as much as the indirect effect. And the indirect effect is basically that global capex and global trade would slow. And in that context, India is sort of least exposed, and that remains the case.
Okay, fair point. India is least exposed. It's only 2% of our GDP that is comprised of exports to the United States. That point is taken. But y'all must have penciled in a 15% kind of tariff. We are now hit with 25 and possibly more. Let's wait and see if we are able to negotiate our way out of that. So because of this 25, are you all giving a downward bias? What is your GDP number, and is there a downward bias?
So our GDP number is, it's on for the full year, we are at, full year calendar year 2025, we are at 6.4. And we had built a slowdown in growth on account of the expectation that tariffs would be lifted up across the world. And as I mentioned, we have built a lot more out of global trade downside, and that affects India's overall trade, not just exports to the US, but overall trade would slow because there is a slowdown in global economy and global trade that is coming up upon us. And with that, we built quarterly GDP growth in India slowing to 5.9% in the fourth quarter, and that would have been the worst in terms of the downside impact. Now, clearly, if there is, this 25% number that has been announced for India, if it stays for longer, our current expectation is that there will eventually be negotiation between the two countries and the tariff rates will come down. But let's say, assume that this tariff number stays and we have additional tariff on account of Russian crude purchases, then there is definitely some downside risk that we have to consider. And just one other thing I wanted to highlight, you mentioned India's exports exposure to the US is 2% of GDP. That's actually 1.4. If you take out the stuff which is exempted, this electronics is exempted, as you know, that's a big line item from us to the US now, and it's probably going to get bigger with iPhone exports. That bit is exempted. So that is 1.4% of GDP. So that's even smaller. But as I would just want to keep reminding that the bigger story that we have to worry about is the global trade slowdown and downside from that, less about the direct effect of tariffs on India.
No, I take your point. There is the larger one, but the market is worried about current EPS and next quarter's EPS. And there you have to, write in the tariffs for textiles. Incidentally, it's also pharmaceuticals that have escaped the tariff for now, which is also a somewhat of a line item in India, electronics being the bigger one. But Chetan, what about the subsequent years? Morgan Stanley was pretty bullish that India is going to have, up till 2030, probably a 6.7, closer to 7%, 6.5% to 7% kind of growth. Do you think that with this tariff uncertainty and the China plus one story, therefore, kind of losing its sheen, will we have to, look for downside risks down the line as well?
That's unlikely, Lata, because I think we're sort of building in this downside on account of tariff to be there for the next 12 to 18 months from a global standpoint, and therefore that would sort of weigh in on India's numbers as well. But beyond that, we think that we will sort of still be looking at the India story, which is to be decided by the Indian policymakers. I think there is a lot more that the control in terms of India's growth outlook is very much with the Indian government. Unless we're expecting that there will be a significant global trade slowdown persisting for the next 3-4 years, this should not be an issue that kind of affects the medium-term growth story for India.
Okay, what are you expecting in terms of inflation? Will there be further disinflation because you're not exporting much to the United States? And therefore, India, what is your India number and what is your expectation from the Reserve Bank?
So right now, we're expecting inflation to be in the range of 4.5%. But we are getting, and if you look at the core inflation numbers, they're pretty much in line with that. The downside risks are still there. One is because monsoons have been great, and so food prices may remain low. And at the same time, we still continue to see this disinflationary pressures emerging from China. Also on account of the fact that there is a global trade slowdown that is upon us, that will also have further additional disinflationary pressures on India from the external side. So we think that the risks are that you probably would see inflation surprising on the downside.
Okay, and therefore rate cuts more. Therefore, you're expecting rate cuts.
Yes, yeah, we are. Sorry, I missed your question. So yeah, I think we are expecting one more rate cut in October. And if there is more downside risk materializing to inflation, then we'll probably see additional rate cuts.
Okay.
I think it's already kind of quite weak. If you look at core WPI, I would say look at manufactured products inflation. That's running at around 2%. And it's been running between 1% to 2% for a while. And so, yeah, I think the risks are to the downside on inflation, and therefore there is a chance that RBI actually does more rate cuts than what we have in our base case.
Okay. Chetan, we have some breaking news coming in, and therefore I have to run into a break. Just a final word on when do you all see US inflation coming up and therefore your Fed rate trajectory?
So for the US, we are building in core PCE inflation, which printed yesterday at 2.8%. We expect that to go to 3.2% by the year end. And therefore, our US economics team is actually not building in any rate cuts for this calendar year. They have it only in the first quarter of next year. Of course, it depends upon the labor data that we get today in the evening. But to the extent to which we are not expecting a very sharp deterioration in the labor market, and we see that inflation is going up to 3.2%, we think that Fed's hands would be tied in terms of rate cuts this year.
Okay. I'm sorry, I'll have to wind this up a little faster than I thought. We have some breaking news coming in. Chetan Ahya, thank you very much indeed for sparing time for us this morning. It's a quick break, but we are back in a jiffy, and there's some big breaking news awaiting you.